Every government in the world tells you the same thing. Inflation is a problem. They hold press conferences about it. They raise interest rates to fight it. They talk about it like it's an enemy. But here's what they never tell you. Inflation is also one of the most powerful financial tools a government has ever discovered. And the people running the system, they know exactly how it works. You've probably felt it. The price of groceries goes up. Your rent goes up. Gas goes up. And your paycheck? It goes up a little. Maybe. If you're lucky, in 2021, inflation in the United States hit 7%. By 2022, it reached over 9%, the highest it had been in 40 years. Millions of Americans watched their savings quietly shrink. Not because they spent more, not because they were careless, but because the dollar in their bank account was worth less than it was the year before. $100 in January, worth about $91 by December, just sitting there, doing nothing, disappearing. Most people blamed supply chains. They blamed oil prices. They blamed the pandemic. And those things were real. But they weren't the whole story. Because inflation doesn't just happen to governments. In many ways, governments make it happen. And when it does, they benefit. Meet Daniel. He's 36 years old. He works in logistics management in Ohio. Makes about $62,000 a year. Daniel is responsible. He pays his mortgage on time. He drives a used car. He puts a little money aside each month. He does everything right. In 2019, Daniel refinanced his house, locked in a 30-year mortgage at a fixed interest rate. His monthly payment, $1,180. At the time, that felt like a lot. But then inflation came, and something strange happened. Daniel's salary went up. Not because he got a promotion, but because the company gave him a cost of living adjustment. $62,000 became $66,000, and then $69,000. Meanwhile, his mortgage payment stayed exactly the same, $1,180. Every month, like clockwork. The debt didn't grow with inflation. It stayed frozen in $2019. But Daniel's income, it moved with the times. Without realizing it, Daniel had stumbled into one of the oldest tricks in the financial playbook. He was repaying an old debt with cheaper money. Now imagine doing that on a scale of $30 trillion. That's what the US government does, every single year. Here's the first hidden rule. Inflation is a silent tax on savers, and a silent subsidy for debtors. The United States government currently carries more than $33 trillion in national debt. That number is almost impossible to imagine. But here's the thing. That debt is mostly fixed. Treasury bonds, fixed payments, locked-in interest rates. When inflation rises, the real value of that debt shrinks. Not on paper. The number still says $33 trillion. But in terms of actual purchasing power, the burden gets lighter. Think of it this way. If you borrowed $100,000 in 1990, you owed $100,000. But $100,000 in 1990 could buy roughly $230,000 worth of goods today. The debt stayed the same. The world moved on. Economists call this debt erosion, and governments have been using it for centuries. After World War II, the United States had accumulated enormous debt to fund the war effort. Rather than raise taxes to unbearable levels or slash spending overnight, they did something else. They let inflation run. For years. Slowly, quietly, the debt burden shrank as a percentage of the overall economy. By the 1950s and 60s, the debt that had seemed crushing was suddenly manageable. Not because they paid it off, but because inflation had done the work for them. The bondholders and savers who lent money to the government, they got repaid, technically. But the money they received was worth less than the money they lent. The government won. The savers lost. And nobody held a press conference to explain what had just happened. Here's the second hidden rule. And this one is even more invisible. It's called bracket creep, or fiscal drag. And it quietly moves money from your pocket to the governments every single year. Here's how it works. Most countries have a progressive tax system. The more you earn, the higher percentage you pay. That sounds fair, in theory. But here's the catch. When inflation rises, wages tend to follow. Maybe not perfectly, maybe not fast enough, but they move. And when your wage goes from $50,000 to $55,000 because of inflation, on paper, you look richer. But in reality, you can buy the same amount of stuff, maybe less. Now, here's where the government quietly wins. Because you're earning more dollars, you might cross into the next tax bracket. You pay a higher rate. Even though your real purchasing power hasn't improved at all. The government collects more tax revenue. You feel poorer. And nobody called it a tax increase. Because officially, it wasn't. Sarah is a middle school teacher in Tennessee. She made $48,000 in 2020. After inflation adjustments, her district bumped her to $53,000 by 2023. She didn't feel richer. Her groceries cost more. Her utilities were higher. Her car insurance had gone up. But she was now in a higher tax bracket. She paid more to the IRS. Her real income, basically unchanged. The government's real revenue, higher. That is bracket creep. Quiet. Automatic. Everywhere. And it happens in almost every developed economy in the world. Some countries index their tax brackets to inflation. They adjust the thresholds every year so workers don't get pushed up automatically. But many don't. Because why would they? The math works in the government's favor. Now let's zoom out. Because this isn't just about one mechanism. It's about a system. A system that was built over decades. And it doesn't always work the way the civics textbook says it does. Modern governments run on debt. Always have. They borrow money by issuing bonds. They promise to pay it back. With interest. And here's the architecture that most people never see. The central bank, in America, that's the Federal Reserve, has the power to influence how much money circulates in the economy. When they create more money, prices tend to rise. That's inflation. Now, the government borrows money. The central bank, in certain situations, buys government bonds. This pumps money into the economy. Prices rise. The government's old debt becomes easier to repay with cheaper dollars. Tax revenues grow automatically without a new tax bill. The cycle repeats. This isn't a conspiracy. It's not a secret meeting in a dark room. It's just how the machinery works. And the machinery has a logic. Consider what happened during COVID-19. The US government needed to spend trillions of dollars almost overnight. Stimulus checks, loans to businesses, hospital funding. They borrowed at an extraordinary scale. The Federal Reserve bought trillions in government bonds. The money supply exploded. By 2021 and 2022, inflation was the highest in a generation. But here's what most people missed. The US government's debt to GDP ratio, the measure of how heavy the debt burden really is, actually fell. Not because they paid it off, but because GDP grew in nominal terms. Inflated numbers. The debt got lighter. The economy looked bigger on paper. And the government collected record tax revenues. In 2022, the IRS collected more tax dollars than any year in American history. Not because tax rates went up, because incomes went up, nominally, and the brackets didn't fully adjust. The system did exactly what it was designed to do. Here's where it gets uncomfortable. Because you might be wondering, is this fair? And the honest answer is that fairness depends on where you're standing. If you own assets, a house, stocks, a business, inflation often works in your favor. Your asset prices rise. your fixed-rate debt shrinks in real terms. You build wealth almost passively. But if you rent, if you're living paycheck to paycheck, if your savings are sitting in a bank account earning 2% while inflation runs at 7%, you're losing, quietly, every day. The people most hurt by inflation are the ones with the least cushion, the ones who can't afford to own assets, the ones who don't have a 30-year mortgage to let inflate away, the ones who depend on cash savings. Robert Shiller, the Nobel Prize-winning economist, has spent decades studying how ordinary people understand and misunderstand inflation. His research suggests that most people know they're falling behind. They just don't know why. They blame their boss for not paying them enough. They blame the grocery store for raising prices. They blame themselves for not being disciplined enough with money. The system remains invisible. And that invisibility is part of what makes it so durable. Because a tool that nobody sees is a tool that nobody fights. Think about the last time there was a serious political debate about the debt erosion effect on ordinary savers. Or about bracket creep. It rarely happens. Because these mechanisms don't look like policy decisions. They look like math. They look like neutral forces. They look like nobody's fault. But they didn't design themselves. Inflation is not simply a failure of management. It is not always an accident. It is a force that governments have learned to use, to erode debts that would otherwise crush them, to collect more revenue without passing a single tax bill, to make the economy look bigger on paper than it feels in your wallet. That doesn't mean every government official is cynical. Most of them are trying to manage impossible trade-offs. But the system they operate in has a logic. And that logic rewards borrowers. It rewards asset owners. It rewards those who understand what money actually is. Money is not a neutral store of value. It never was. It is a claim on resources. And the rules about how that claim changes over time, they were written by people who benefit from the answer. Daniel still makes his mortgage payment, $1,180. Every month. He didn't design the system. But the system is working exactly as designed. The question is not whether inflation is good or bad. The question is, who does it work for? And now that you know the answer, what are you going to do with that information?